Good morning and a warm welcome to our Investor Day participants, both here in the room and out on the web. As we prepared this day, it became clear to us that the last time we met in a setting like this was more than 3.5 years ago, and that was in Arlington in May 2019. And yes, what a different world it's been. Global pandemic and many, many crises later, here we are, glad to see you in person, and we appreciate your interest in our company. One of the messages that hopefully will come across from this day is, while we're living in a very volatile and turbulent environment, I think we have the strategies, we have the operational dedication, the execution to provide very consistent financial results for you, very much in line with the Nestlé model that was outlined to you many years ago, and that allows you to create value through compounding in investment. Here's a brief summary of what we would like to try to get across today. Looking back first, I think in all modesty, we have delivered to you. We have delivered not only in the pre-COVID years, 2017 through 2019, with a very balanced approach on growth and earnings. I think we also have delivered to you in these very turbulent years, 2020, 2021, and 2022. 2020 was all about coping with COVID. 21 was supply chain. 22 is the year of inflation. And I think in all of these very surprising, turbulent environments, we did what we have to do short term to make sure that our financial model gets upheld and that we live up to our purpose in every way. Now, that's the past, and today's program is about looking towards the future. And the message we're trying to get across is, as we look at this new decade we're in, this more turbulent, this very volatile decade, it's important that we believe we get it. We're looking forward. We're trying to embrace the realities of this new decade. It's going to be a decade of higher highs and lower lows. It's literally going to be a tale of two cities, best of times, worst of times. And in this new environment, we're trying to embrace that new reality, make the most of it. And at the bottom, as mentioned before, we believe that even in this environment, we can uphold the main key cornerstones of the Nestlé model and the value creation behind it. To set up the program for today, let's take stock about what has worked for us in the last few years and also what hasn't, because I think that's an important starting point to see where we're going. And page one is the items that have worked for us. I will not go in detail through all of them. You know many of them from past investor calls, quarterly or annually, and some of the past investor days. What I do hope you appreciate is the balanced delivery across a number of dimensions here, whether it's strategy, organization, or the balanced pursuit of our financial goals. I think that was underlying that very consistent, sustainable success over the last few years. Now, here's a look at some of the things where we believe we have work to do. And there is three categories. One is Nestlé Health Science, which is going to be a focus item for today. I'll talk about it some later in this presentation, but then obviously we spent a lot of time on this in the afternoon. Infant nutrition is another category where we have not fully lived up to our goals over the last few years, and I'll spend a slide later detailing the new strategy in infant nutrition. Water, I won't spend a lot of time on. Let me just say that I think we did a very important step in 2019-2020, focusing on premium functional waters. I think now in the face of additional inflation, we have to try further measures on cost efficiency, value-added offerings, and also sustainability to balance all of these objectives. Affordability, sustainability, I think that is an item that has come to the forefront in the face of very significant inflation. There's no point in making the perfect product if it cannot be supported and embraced by the consumers around the world. So making sustainability relevant to consumers, bringing the consumer into the equation, in addition to regulation that happens around the world, I think is one key ongoing challenge that we'll be working on. And then also, I think when it comes to quality, let me assure you that we do have a very, very strong focus on this. This has always been a hallmark of the company, but we also can't help but notice that we did see a pretty significant setback earlier this year with the Buitoni situation in France. Let me assure you, the quality focus has never slowed down. We're taking the situation very, very seriously. We do one post-mortem after another to be sure that across all levels in the organization, this quality item is properly addressed and that there's proper learnings from it so that they don't happen again. And last but not least, speed, speed, speed. I think execution is going to be a major item in the 2020s, especially against the face of the significant volatility and turbulence we're seeing. You can have the most wonderful strategy. If you don't execute on time, if you don't make it happen with a razor-sharp focus, it simply won't pay the results. Lots of change, but also one constant, and that is our strategy. That slide has changed very little from our presentation in May 2019 in Arlington. There had been a development from the one we showed you in 2017 to 2019 because, as you know, we divested of Nestlé Skin Health and we put in this focus on food and beverage, which I think was accepted and understood very well. Since then, the focus is the same. What you will see this afternoon within Nestlé Health Science now, we will have even further focus on the two segments that were performing the best, and that is consumer care and medical nutrition. But when it comes to the scope of the entire company, no change of parameter from what you've seen and what you heard before. Within the food and beverage categories, here are two planks that we believe are going to be really, really important for the 2020s and beyond. We summarize them very simply with good for you and good for the planet. Good for you captions all the items that are related to the nutritional value of our products. And good for the planet, given that food and beverage does account for a major part of the environmental footprint that humanity has on this planet, basically summarizes all of the ESG-related aspects related to our products. Good for you. You know that we're stepping into a proud heritage over 20, 25 years under our nutrition, health, and wellness strategy, which we fully confirm. As part of the strategy, we've seen major successes in taking sodium, sugar, and saturated fat out of our products, and we stay committed to this journey and using our R&D engine and innovation engine to making that happen. But let's also be clear, with all the science in the world, what you won't be able to do is to turn a piece of chocolate into a tomato. So we've got to be realistic on this, and that's where some other dimensions of what we call responsible consumption kick in. And you see some of those itemized here. One is around creating absolute transparency, which starts, for example, with food labeling, but also goes to annual reporting so that the public can track our progress. You will have seen 2 weeks ago, we made an announcement. It's, to our knowledge, the first of its kind globally. We're starting from next March. We will provide, against the Health Star rating, a complete global overview of how the portfolio is categorized. I think that'll allow you to show you and to track very easily the progress that we're making across the entire portfolio. In addition to that, later in 23, in 14 major markets around the world, we will detail how the country portfolio stacks up against relevant nutritional systems that are used in those countries. So here again, at the local level and at the global level, this will allow people to track our progress and see how we're doing. On the right-hand side, responsible marketing, I think, is another important piece of the equation. Absolutely important in the field of infant formula, infant nutrition. And here I just want to remind everyone that starting January 1st, our new infant formula marketing policy comes into effect. This follows an earlier commitment. And so based on the belief that breastfeeding is best, for 0 to 6 months around the world, we will abstain from any promotions. And then for 163 countries around the world, where according to objective FTSE for Good criteria, there's a higher rate of infant malnutrition and infant deaths, we will also have a 0 to 12 absence of promotion. So that puts us very squarely into the leadership pack when it comes to infant formula around the world. And then just yesterday, we made an announcement when it comes to marketing to children. We had a previous policy of 0 to 13 years. We now enlarged that to 0 to 16, which also puts us in the leadership pack globally. That policy will go into effect July 1st next year. Good for the planet. I won't go through all of these metrics, but as you know, We've made some very significant commitments over the last 5 to 6 years. We're on track to either fulfill the gist of these commitments or to fulfill them actually to the letter. Very glad to report that we have left peak carbon behind us. It was sometime 2018, 2019. Also glad to report on packaging that we've left peak virgin plastics behind us. And then, of course, when it comes to another very important item, which is supply chain due diligence, also a very large number of initiatives underway and good progress when it comes to the execution. Let me shift gears and talk to you about portfolio management. And portfolio management here, for the purposes of this slide, is defined as the narrow angle portfolio management. So this is M&A, this is buying and selling. Obviously, there's a lot of day-to-day portfolio management going on when we develop new products, when we develop new categories internally, and that should not be underestimated. But as you can imagine, what grabs the headlines and what you very often focus on is some of the portfolio management that happens through buying and selling. And taking stock here, after a number of years, 3 key observations. One is we have been quite active, certainly more active than we led you to believe at our investor seminar in September 2017 in London. So you see we rotated more than 20% of the portfolio, total deal value in excess of 50 billion Swiss francs over the years. That leads me to the second conclusion. Had we been less diligent, we could have easily doubled that on the buying side. And so we've been very selective buyers, we've been very disciplined. Certainly when we didn't like things that we see in a due diligence process or when we didn't like the valuations anymore, we had the guts to say no. And Francois will outline this later in his presentation. These were not superficial glances we were taking at those transactions. These were things that we looked at very seriously in detail. We ended up not liking some aspects of it. It may have been tempting, it may have been tantalizing, but we had the guts to say no. And I hope you appreciate that. And then coming to the third bullet point, what did it all add up to? Well, the first 2 sub-bullets are about the operating metrics. And there clearly, we believe it did contribute. So it is about 50 basis points per annum when it comes to organic growth. And it stands, when you look at the buying and the selling, it stands for around 1/3 of the improvement in underlying trading operating profit margin. So I think when it comes to the operating metrics, these transactions have certainly helped. When you look at the third sub-bullet, you also see that more than 80% of these transactions have either met or exceeded the acquisition business plan. And then looking at the fourth bullet point, what we're doing is we're netting out for you the ones that have met or exceeded their targets or the ones that have not. And we're using a valuation metric and system that's very much inspired by private equity, where what you typically do is you take the current performance in terms of sales and earnings, and you apply a current market multiple to these transactions to get a sense even for unrealized transactions where they stand. And when you apply that here, about 7 to 9 billion Swiss francs of value were created, which equates to an annual return of about 11 to 13%. So I think whichever way you look at it, operating metrics, hit or miss, or whether it's the total value created, we did overall, I think, have a pretty good acquisition track record. Now, that's the positive side, but of course, when we're saying more than 80%, the more curious among you will probably ask the obvious question, what about the others? And here are 2 transactions in the spirit of full disclosure that I would want to talk about that did not meet our objectives fully. The first one is Freshly. And that one, I know over the last year or so, we have received a number of questions, so some of you were on this case already. You may have seen a very recent announcement just from a few days ago that we merged this company now with a business called the Kettle Cuisine Company. We're doing this in partnership with a private equity firm called Catterton, and we're in a minority position, they're in the majority. As you know, this business was acquired just about 2 years ago in the fall of 2020. We had been a minority owner of this business for 3 years before, from 2017 through 2020. And basically, I think what happened here is the insight that a D2C channel for a business of this type, in the face of rising customer acquisition costs because of a totally different data landscape, and also with lower customer retention in this COVID waning world is simply too narrow. And I think this is something that we had to recognize. This is probably where the environment in 2020 fooled us, because we still had much, much lower customer acquisition costs in this cookie-dominated data acquisition world. You'll hear more about that in the changes later on this morning. And then, of course, as the pandemic waned, clearly customer retention didn't maintain the levels we saw during the pandemic, and hence the narrowness of this business case became so much more apparent. That's also the solution now, I think, and by the way, this is also a general lesson that for many D2C business models will need to get applied. Unless you have something that's truly premium, truly high involvement, truly fully personalized, a pure D2C model at times can be too narrow. I think with this merger now, with the business of Kettle Cuisine, we're bringing together two business models that have one thing in common, and that is the focus on freshness, because that is something that customers do appreciate and consumers do appreciate. But then you also bring it together with a much more nuanced way of going to market, using B2B2C models where you're working with food service operators, canteens, for example, restaurants, hotels, and environments like that would like to offer something that is fresh, but don't have the cost and the labor anymore locally to prepare these meals. And that business model is very promising, especially in this oncoming age of labor scarcity. And I believe that this joint venture also, while the acquisition has not met fully its objectives, it gives us a chance to earn a substantial part back of what we didn't realize in the first round. So that's one. And the second one, building on this morning's press release, is Aimmune. And so this is Nestlé Health Science, and this may come as a surprise to some of you, given that we did have high hopes for this business. I'm the first one to admit it. This is a business that we also acquired in the fall of 2020. We also had a minority stake in this business from 2017. So we followed the development of this company as the product underwent the clinical trials, and finally in early 2020 got the full FDA approval. That was important to us. We didn't want to move on this business before we had a fully FDA-approved therapy, because we didn't want to take scientific risk here. And then what we thought, in an area that sees significant unmet medical need, was that there was going to be a launch that we could support in many different ways through our Nestlé Health Science organization. First, as you know from some of the quarterly updates we've given you, that was hampered by the pandemic. The fact that, when risk of infection was so large, people simply didn't want to go out and visit the allergologist office and basically try a new therapy like this. But when that started to wane, we saw that there were two more significant underlying problems that have nothing to do with the therapy. Let me stress that the therapy is absolutely safe and also effective, very much in line with the approval that it has received. It's still, to my knowledge, around the world, when it comes to peanut allergy, the only FDA-approved therapy. One problem was that allergologist adoption was not as strong as we anticipated. That has to do with the workload that this therapy puts on the allergologist office, for which the allergologist does not get compensated, and under the rules and laws, we're not allowed to make up for this. And then second, with the patients, clearly, while there was strong interest, especially from parents of concerned children that have peanut allergy, the discipline and the patient retention was not as good as we thought, given that this requires multiple visits to the allergologist office, and then each and every time one of these escalating doses is applied, you also have to spend considerable time in the practice to be sure that there's no anaphylactic shock. So when you put all of this together, clearly it was much, much harder to get the patient take-up that we anticipated and that we felt was to be expected because of the strong underlying medical need. This is a reality we have to accept. So instead of the blockbuster, what this looks like more and more is a very potent and very successful niche therapy. Now, some of you may ask, if that's the case, why don't you stick it out? Why don't you expand it patiently over time? And I think this is where our previous footprint comes in. When you're circulating, when you're selling an FDA-approved RX drug, you need to have certain fixed cost in order to support that by law. Think about pharmacovigilance, for example. And so clearly, when you are starting in this, when you don't have other trucks that you can bundle in with that, then that fixed cost is really quite a burden unless you're seeing the rapid success that we had forecast. And hence, when we saw that the takeoff is not what it is, and that it would take much, much longer to create a strong niche following for this drug, and that we have all the fixed cost against it, we felt the best way for this company, the best way for Nestlé Health Science going forward, is to stay focused. I know some of you never liked this therapy to begin with. You felt that it was outside of the wheelhouse of our company. And so that also paves the way then to the new strategy, which we believe is going to be more proven, more successful for Nestlé Health Science. And that is resting on the two pillars where we have every right to play and every right to win. One is consumer care, and the other one is medical nutrition. In both of these, we're among the leading providers in the world. Consumer care in the VMS sector, we're clearly number one by now. It's a still fragmented industry, but also one that allows significant consolidation opportunity going forward. In medical nutrition, as you know, we have decades of experience. We're a strong number two globally. And when you look at the top 4 companies in this space globally, you essentially have 2 consumer goods players and 2 medtech players active in that. So I believe it's long established and well accepted by everyone that as a consumer care company, you can play an important role in that space. That whole strategy, the 2 segments, the promise they hold, and the track record we have in them will, of course, figure very large in this afternoon's program. And I hope that you come away with the strong confidence that in these 2, we have a bright future ahead of ourselves. Infant nutrition, this is another segment, as I mentioned earlier, where over the years we have not quite delivered. Some of that has to do with the global situation, especially falling birth rates, in particular at the times of COVID. But some of it also, very frankly, had to do with our own internal execution problems, in particular in China. We took a good look at this, specifically at the situation in China, but also at the global landscape. And as you know, this is a category that is very, very much key to us, one that the company was founded on, and very, very much aligned with our purpose of using the power of nutrition. Especially at this early stage in life, I think this is where a lot of good can be done, a lot of bad can be avoided. It's clear to us, when you look at this 8 billion Swiss franc category, dominated by about 3/4 infant formula share, that there's no successful strategy that doesn't build on revitalizing the core. So if you don't revitalize the core, whatever you do as new growth initiatives will not be successful. And hence, you see here several initiatives that are built exactly on doing that. The key part, of course, is the turnaround in China, where, proud to say, we've seen significant progress this year. This is also where the Chinese reorganization has kicked in and helped a lot. And it's also a good coincidence that our new executive board member and head of Nestlé Greater China, David Chung, has a strong history in this business. He served in it at the time when it still belonged to the previous owner, and has a lot of personal pride, took a lot of personal pride in turning around the situation, and I think we'll stand to reap the benefits of that situation going forward. So I think that, to me, is key. You've seen from some other international players there can be winning strategies in the Chinese market. I think we have recently turned around to be on the winning streak, and will continue to do that. In addition to that, of course, on a global scale, it's very much driven by science and innovation, and you'll hear some of that later on in Stefan Palzer's presentation. Over and above that, we believe there is a growth opportunity by widening the angle, and that is, rather than focusing on just infancy and toddlerhood, I think if we now go from preconception to preschool, we have a wider way of offering nutritional solutions to help those pivotal early years in life. And this is where a few other segments come in. So for example, the supplement segment when it comes to pregnancy and pre-pregnancy, and then also meals and drinks for the preschool age. This is where a lot of specialties can be offered, a lot of brand names that we already have in place can be leveraged, and this is what we intend to do going forward. Again, it'll help to offset some of the more muted growth aspects of this category in the face of rising breastfeeding rates and also falling birth rates around the world. But it alone will not be successful if we don't turn around the core, which we're very committed to doing. Turning around the core, by the way, in the face of falling birth rates, there is more growth opportunity than you think, because at the end of the day, it's also about market share, not only against other infant formula makers, but also against clearly inappropriate ways of feeding children at that age. And that is still very prevalent around the world. And by touting the virtues of proper infant formula feeding when breastfeeding is not possible, we believe that additional growth can be generated. Switching gears again, let's take a look at some of the financial metrics. We'd like to have you come away from this Investor Day today by having confidence that we have what it takes to deliver consistent mid-single-digit organic growth going forward. This is something that we called out to you last year. Compared to the original plan from 2017, we were about a year behind. As you know, we were a year early in earnings. We were a year behind on organic growth. I want to confirm again today that we believe we have what it takes to do that. It may look easy at a time like this, when inflation, of course, inflates the numbers. But even aside from that, even in a more normalized going forward scenario, we believe, based on the categories we're in, the mixed development, the innovation we can bring to market, we have what it takes to deliver that consistently. And that's a key feature of value creation going forward. The drivers on the right-hand side are the same that you've seen in previous updates we've given you. Likewise, on margin, that's the other one that's important. We have what it takes, and we have the plans in place to go back to the margin band that we outlined to you in London in 2017, 17.5% to 18.5%. Again, some of the steps, some of the drivers on the right-hand side, very similar to what you heard before. And that's important to me because, as we all know, when inflation was gearing up last year and this year, everyone's operating margins in this industry were taking a hit. I'm sure it would have been tempting to kind of reset expectations here. We're not in for that. We believe that this company can deliver this margin band in a very consistent manner in a more normalized situation, and we intend to get back there. That leads to a key financial metrics slide, which Francois will present to you in greater detail this afternoon. As you look at some of these metrics, be careful. Some of them relate specifically to the year 2025. Others relate to the entire period gearing up to the year 25. So, for example, the annual underlying EPS growth, that is something that we expect very consistently between now and 2025. By the way, that does not only apply to the underlying EPS growth. When you look at the math of what we intend to do on organic growth and the underlying trading operating profit margin, that also applies then to the annual underlying trading operating margin development. So there also we expect clearly an above 6% development between now and 2025. That's simply by putting the two together. Everything else I would call a positively trending, no surprises scenario. And in a world that is full of turbulence and surprises, I think that is a positive surprise to begin with. All of that, as you know, adds up to a pretty consistent financial performance over the years. You see that itemized on the left-hand side of the slide. We're fully aware that this year doesn't stand out as much as in previous years. But as you look at it on a 3, 5, or 10-year time horizon, you see that very consistent performance and the power of compounding here when it comes to creating value. And regarding the center and the right-hand side of the slide, I would also like to confirm that we fully intend to continue our long-standing dividend practice of rising dividends, and that, of course, I would like to fully confirm that the current share buyback program will be continued in full compliance with the outline we gave you last year. All of this does not happen on autopilot, and so that's why I also wanted to spend a second on some of the organizational changes that are needed to make this happen. This is the 2020s. This is an age of significant turbulence and volatility. I think it's also in the face of a changing consumer and the prevalence of all things local and a more troubled geopolitical environment, an age where local clearly comes first and global second. I think we benefit from the fact that about 20 years ago, in a day and age when global was all the rage, we never went all the way there. I think we always kept that very strong local rooting in our organization, in our manufacturing setup, in our supply chains. And we stand to benefit from it now. In fact, going forward, we will stress it even more. Going to the center of the slide, one aspect of this was the breaking out of our two largest markets last year and the creation of their own zones for North America and for Greater China. I would like to confirm to you that that change has gone really, really well. I think it has already led to much, much shorter paths to create decisions, and it also has led to a much more nuanced debate around the executive board table when we have our senior leadership meetings. And then the last one at the bottom, you'll get a taste of some of the consumer-facing digital activities. But let me also say, beyond the consumer-facing part, when you look at the inside of a company, to me, COVID, if there was any one positive thing related to it, then it's the fact that it was the starting shot for so many companies around the world, us included, to start what I call the full digital build-out of what a company can be if you're using it front to back and top to bottom. And this is something where a lot of effort, a lot of investment over the years will be guided to be sure that we're ending up with a fully digitally enabled, fast and very skill set related headquarters organization that can thrive in this new environment against everyone speeding up. Some of you may remember that slide from September 2017. Same slide, totally unchanged. And let me give you the same three messages. Number one, on a personal note, I'm fully committed to this job. Number two, I'm here for the long term. And number three, when you go beyond me into the full team, I would want to assure you of our grit and determination and the sheer will to succeed in this new environment of the 2020s. So past success is the past. It's all about the future. This team wants to win. We play to win. We will.